In this video, I'm going to run you through what an exchange traded fund is, the two main types of exchange traded funds, and the costs associated with each. So let's get straight into it. Imagine an exchange traded fund or ETF as a fruit basket in the financial marketplace. Instead of buying individual fruits like stocks or bonds, you get this well-arranged basket containing a mix of apples, bananas, grapes, and maybe even a few exotic fruits. Each fruit represents a different asset in the ETF. So just as fruit basket gives you a diverse taste of flavors, an ETF provides a diversified mix of assets in one investment, making it a convenient and varied choice for your financial appetite. So what type of ETFs are there? Active ETFs and index tracking ETFs. Now think of investing like hiring someone to shop for groceries on your behalf. Active managed funds are like hiring a personal chef who handpicks the best ingredients, customizes recipes, and charges a premium for their expertise and time. The cost is higher because you're paying for their skill in actively managing and selecting assets. On the other hand, index tracking ETFs are set to a grocery shopping service that follows a predetermined shopping list or index. There's no personal chef involved, just a straightforward, systematic approach to getting what's on the list. As a result, the service is more cost effective since you're not paying for the personalized touch and constant attention of a chef, but it may take you more time as you will have to take on more of a role in selecting the right foods for you. In the investment world, this reflects the lower fees of index tracking ETFs compared to actively managed funds. So what are the costs? In Australia, active managed funds are often more expensive due to the costs associated with hiring professional fund managers and conducting in-depth research to actively select and manage investments. These fees will include: number one, management fees. Active funds typically charge higher management fees because they employ skilled fund managers who actively make investment decisions. These managers are compensated for their expertise and the time they spend researching and managing the fund. Number two is research and analysis. The costs associated with in-depth analysis, market research, and ongoing monitoring contribute to the higher expense ratios. Number three is transaction costs. Active funds may incur more transaction costs as they frequently buy and sell securities to capitalize on market trends or adjust the portfolio. Number four is performance incentives. Some active funds implement performance-based fee structures where fund managers receive bonuses if they outperform specific benchmarks. Number five is active management. The active management approach requires continuous monitoring and adjustments of the fund's holdings based on market conditions. This hands-on approach demands more resources, contributing to higher operational costs. Okay, and the costs associated with an index tracking ETF will typically include: number one is expense ratio. This is the annual fee charged by the ETF issuer as a percentage of the fund's assets under management. It covers operational and administrative costs. Index tracking ETFs are known for their low expense ratios compared to actively managed funds. Number two is brokerage commissions. Investors may incur brokerage fees when buying or selling shares of an index tracking ETF. The cost depends on the investor's brokerage platform and the frequency of the trades. Number three is transaction costs. These are costs associated with the ETF's buying and selling activities, including brokerage fees, bid-ask spreads, and other expense-related trading. Overall, index ETFs in Australia generally have lower expense ratios compared to active managed funds. These lower costs can have impact on long-term returns, but it's definitely best to seek professional help and always do your own research and invest in things that you have a good knowledge of. There's also numerous studies, including those specific to the Australian market, that indicate a significant percentage of actively managed funds underperform their benchmark over extended periods. This challenges the idea that active management consistently generates superior returns. While there may be individual actively managed funds that outperform in certain periods, the overall trends and factors mentioned contribute to the growing preference for index ETFs among Australian investors seeking cost-effective, diversified and transparent investment options. So to sum up, an exchange traded fund or ETF is like a pre-packed fruit basket or a grocery shopping service for your investments. It combines different assets such as stocks or bonds into one package. If you prefer a personal chef to handpick and manage your ingredients like in actively managed funds, it could cost more. But if you're happy with a ready-made mix following a specific list, like in index tracking ETFs, it tends to be more cost-effective. ETFs give you a convenient way to invest in a diversified basket of assets without breaking the bank. Well, I hope this has helped you understand what an ETF is, the types of ETFs there are, and the costs. Thanks for watching, and I'll see you on the next one. Peace.